Good morning and welcome to the last in the series of webinars called The Tools We Use to Manage Portfolios. My name is Toby Potter, I'm from IMAP, and it's a pleasure for me to have you join us today. Through this series, we've looked at the technology that's used in managed accounts, initially in portfolio construction, research, manager selection, manager comparison. Then last Wednesday, we looked at the ways in which implemented portfolios and Watershed use technology to manage portfolios and to actually deliver their individual managed accounts. Today, we're going to look at the more technical aspects of technology in a portfolio management context. We're going to be looking today at client reporting, performance measurement, risk measurement. And it's a pleasure for me to be joined by Nancy Ewan, who's been the moderator throughout this week's series. But before I hand over to Nancy, let me just say a little about the other events which we have coming up through the rest of this half of the year. So in April, we'll be running a webinar series which focuses on what, to my mind, is really one of the probably most topical areas for advice, building a client base of wholesale and not-for-profit clients. For many advice businesses, the decision to adopt a specific wholesale frame of reference is one that they're actively considering. Many clients of advisors would qualify as wholesale. So we'll be joined by both practitioners and by legal advisors in that series as we discuss on Monday, wholesale clients, on Wednesday, not-for-profit, and then on Friday, the business strategy implications of having a wholesale and not-for-profit client base. We'll be joined by John Woodley from Fitzpatrick's and by John Barton from MGD, both of whom will discuss how their strategy has been shaped by issues of wholesale and not-for-profit clients. Then in June, we'll be running our webinar series on asset allocation. But in May, we'll be running the next of our live events, Brisbane, Sydney and Melbourne, for the Advisor Roadshow, looking as we do each year at the business of running an advice practice, particularly with a managed account framework. So I encourage you to join us live in Brisbane, Sydney or Melbourne, or to attend our future events. And then in August, the Managed Account Awards. Those are now live. You can enter and I encourage you to do so for the awards ceremony in August. Through the course of today's webinar, if you'd like to ask a question, please do. It makes it more interesting for everybody. At the bottom of your screen, you'll see a Q&A button. If you type in your question, the presenters will see that and deal with it as we go. So now it's my pleasure to hand over to Nancy Ewan. Nancy is the product manager for GWP, SS&C's global wealth platform, the technology that they offer to investment managers, brokers, portfolio managers, managed account providers as a comprehensive tool for managing portfolios. So Nancy, over to you to introduce today's session and our participants.
Thank you, Toby. Hi, everyone. As Toby introduced, I'm Nancy Ewan, your moderator for today and product manager of SS&C Technologies, GWP. So yes, as for our final webinar series today, we'll be focusing on client reporting and risk management. So the key concepts we would like you to take away from today's session is visualizing portfolio characteristics and portfolio metrics, what performance measures matters, and making the value added tangible for both advisors and clients. Before I walk through our agenda for today, we are delighted to have two experts in our panel that I'd like to give a warm welcome to. So if we can move on to the next slide, Toby. So firstly, we have Chris Robertson, founder of Arthur Austin Advisory. Chris has 30 years experience in the investment management, wealth management, and pension industries globally. His consulting business provides advice and expertise to asset and wealth management teams, investment teams, and boards on major transformation projects across Asia Pacific. And then we have my colleague, David Ryan, who joined SS&C Technologies in 2013. He's responsible for a range of SS&C's software solutions across Asia Pacific, including post-trade data aggregation, investment analytics, and client reporting. David has over 30 years experience in financial services and technology, and has worked in Australia, the Middle East, and the UK for well-known fund managers, asset services, sovereign wealth funds, and buy-side focused software solution providers. So for today, we'll break it up into two components, and we'll start with a quick discussion led by Chris on performance and risk measurement 101. Then we'll have David provide SS&C's performance and risk product overview. We'll then have a Q&A session focused on the topic. The last half of the webinar will be primarily focused on client reporting. We'll start with a discussion between Chris and David around client reporting and what they hear in the market today, followed by David's presentation on how SS&C addresses key needs in client reporting. We'll then finish our last webinar of this series with a Q&A session. So again, please feel free to send questions throughout the session by clicking on the Q&A icon at the bottom of the screen. Like Toby said, it'll make it more interesting. So before we hand it over to Chris, just to kick off the discussion, I just wanted to ask Chris, and how have you seen performance and risk evolve in the past decade, and have the client demands changed somewhat? So over to you, Chris.
Thank you, Nancy. Interesting question, and it's definitely evolved. So just to put it into context, I started a performance and risk analytics career sort of way back in 1993, where it was sort of very rudimentary what was provided. It was very much sort of hard copy, sort of monthly reports that were generated, a whole bunch of numbers, and sort of sent off to the clients. It was sort of briefly reviewed and popped into a drawer to be forgotten about. Sort of as the market sort of evolved and the investment management world's evolved, sort of the investors, and this is sort of right across sort of institutional investors right through to retail investors, they are wanting to sort of understand more and more what's going on to the portfolio in the portfolios and with their investments. So they're wanting to dig deeper into the numbers. They're not just happy with a headline portfolio number. They sort of want to know what those particular sort of drivers of return are, and how they've sort of benefited from that. And also there's been a greater awareness and level of sophistication around the desire to understand the risks within the portfolios. Sort of in the early 2000s, one thing I did observe in the performance and risk space, it was a sort of an area of a lot of underinvestment. So there wasn't a lot spent in terms of firms wanting to uplift their technologies and teams, and a lot of the teams and even now are doing sort of a lot of performance and risk analytics manually, whereas the technology itself advanced quite significantly. So there's a bit of catch up going on across the industry as well. David?
Yeah, look, and I think I'd echo everything that Chris says there. And from a software sort of vendor perspective, what we've seen over that period of time is the wealth side acting much more like institutional, and as Chris said, much more granularity, much more in-depth analysis, and a massive move away from sort of skunk work projects of performance analysts or fund managers doing their own performance on a spreadsheet in the corner, because of the operational risk that delivers. So a major shift towards doing it right, doing it centrally, and having a bit of scale to it.
Thank you, Chris and David. So what I'll do is I'll pass it over to Chris and on to the next slides.
Unmute there. So the first thing I wanted to do is sort of talk about what performance analytics is. So, a lot of people think about performance as just some numbers on a page. The way that I've sort of approached it over my career is the numbers tell a story, and from an investment perspective, and particularly from an end investor perspective, if you go into a sort of a meeting and you say, you know, your portfolio was up 10%, that doesn't really tell the investor much. They want to hear stories. They want to know why, what you've been invested.
Nancy, it looks like Chris has had a dropout there.
Oh, okay, sorry.
Let me pick up while hopefully while Chris is trying to reconnect.
Joining us,
yes.
yes.
Thank you, David.
No problem. So yeah, so you know, what Chris was starting off with there was, you know, that 10% headline number is fine, but people want to understand. Chris, you're back. I'll let you take over.
Sorry, yeah, I dropped out. Where did I fall off?
Telling a story.
Yeah, telling a story. So I'm using GameStop, which is a small sort of gaming store company out of the US. You've probably heard about it in the media. It had some pretty good performance over the last few months. And the other one I'm going to use is sticking with the gaming theme is EA games, so Electronic Arts, and they're sort of, you know, quite famous for some of the big blockbuster games. So if you went into a client meeting and you said to the client, we've had a great year, so I'm using yearly numbers, and if you want to check my numbers, Yahoo Finance is a great resource for this. If we had a great year, the portfolio was up 2,476%, and that's the performance number of the portfolio. And so the clients are going, well, that's a fantastic result. You've done really, really well, but let's dig into it a bit deeper. What was in the portfolio? So there were two stocks of 50-50 weighting, so GME, EA. So GameStop over the year was up sort of 2,454%. So that was a really great result. EA was up, GameStop was up 4,907, so that was even better. So over the year, and EA was up 45% over the year. So in a 50-50 portfolio, you've got the two stocks, you know, one's up significantly and the other one has done okay. That's a contribution. So if you weight those by your 50-50 weighting, you've got a contribution from GameStop of 2,400% and a contribution from EA Games of 23%. So that's sort of taking the headline performance number and breaking it down into the contributions. So still a pretty good result. But then the client would go, well, what about compared to the benchmark if I invested into the benchmark? And so the S&P 500 over that time was up 65%. So we're talking about a 1-year return. And if you look at the numbers then, your GameStop would have outperformed the index from an attribution basis by around 1,000%. So your GameStop is the main contributor to that outperformance, whereas your EA Games would have underperformed by about 21%. So what that's telling us from a story perspective is all of your performance return and your outperformance compared to the benchmarks come from GameStop, your one stock. A lot of people, when they look at performance and attribution, stop there. They go, right, so performance has been good, contribution's good, attribution's good. But the other thing, which I find is often overlooked, and that's probably because there's quite a lot of complexity around it in different ways, is risk. So how much risk has been taken? Well, with this portfolio, I would say significant risk. So firstly, it's only a 2-stock portfolio, so there's not a lot of diversification there. Secondly, it's all in gaming, so there's no sector diversification there at all. And if you look at the standard deviation, which is a very common measure of risk, for GameStop as a stock, the standard deviation was 271% annualized. So it's a sort of a variation returns of around 270%, whereas EA Games is around 32%. So when you're looking at risk like that, if you got your timing wrong when buying the stocks into the portfolio, then your outcomes could have been significantly different. And to give you an indication of sort of risk, for GameStop, the 52-week low was $2.57 and the 52-week high was $483. So if you timed it well and you bought it at $2.50, fantastic, client's happy. If you timed it badly and bought it at $483, you've done badly, clients worse off, clients angry. And to give you an indication for EA, the low was $86 and the 52-week high was $150. So risk is a very important component when talking about investment portfolios and sort of what's the drivers of returns. I think the key thing to draw from that is there's no single metric that can capture the entire story. You have to sort of step through the process. And also, just looking at the high level numbers doesn't correctly provide the context for historical performance, because there's many, many drivers that need to be explained behind that.
Chris, we do have a question here for you, just in regards to, what you've mentioned, that risk is generally overlooked, and because of its complexity. But with advancing technology, do you think that risk tools can be easily adopted by advisors to help them understand the risk factors to assist with their clients' portfolio?
Yes. Short answer is yes. The technology's there. A lot of the performance and risk systems nowadays are off the shelf. Provided you get your data feeds right, the risk tools are there where you can load your client portfolios up into these systems and monitor them from a risk perspective. It's just a matter of really just sort of understanding what the system provides, but also making a decision on what risks are important. So there's many ways of sort of analysing risks within portfolios, and you need to create a sort of a framework within which what risk metrics and the way that you want the portfolios to look from your perspective.
All right,
I think just to add to that, I think that's absolutely right. But we've got to be careful, across the industry of, not just throwing numbers at people, because Chris is absolutely right. When you get down to the risk level, there are so many potential measures. You've got to make sure that what you're presenting to your investors makes sense to them, and it comes back to that story.
Thank you, David. Chris, do you want to continue, or do you need to go to the next slide?
No, we'll just go to the next slide. I don't want to talk. I don't want to dominate. Don't want to talk too much. So we've kind of explained what it is. So it is sort of the various components of performance analytics. Why calculate it? Because you calculate it because it's a measure of how the portfolio is done, but then at the same time, it helps you weave stories into the numbers. And that's a really good way to look at it. It's not just numbers, but it's actually sort of explain, provide you sort of, direction on sort of how to engage with your clients on particular things. In terms of what choices, well, the performance methodology is pretty standard across the industry. There is industry standards. I think the big choice is around your systems and what systems you want to use and things like that. And also whether you want to sort of have a dedicated performance function within your organizations, or whether you want to outsource it to sort of and sort of do performance as a service. There is plenty of choices what you want to do there. And how is it done? Well, we're going to sort of talk through sort of how it's done from a performance and risk perspective through the next few slides, where we're sort of using sort of some system examples and things like that. But really what I want to do first is sort of talk about some of the challenges that are sort of faced across the industry, and it's sort of not just sort of from an advisory perspective, but also across the entire industry. And what we've done here is just popped in a very sort of basic looking portfolio, managed accounts, and it just shows month to date, 1 month, 3 months, 6 months, 1 year, and 2 year performance. So if we just want to move to the next slide. So there are challenges. So firms are playing catch up. As I said, performance and risk has traditionally been an area of underinvestment, finding across all organisations, and we're talking sort of about the biggest super funds all the way down to sort of MDA providers and things like that. A lot of the performance and risk is still being done on spreadsheets or sort of in inefficient manners. Technology is actually run ahead of it. So the amount of tools and technology that are out there that can be used and simply implemented has exploded, and there's a lot of different systems and things like that can be used. The other thing I would point out with technology is the costs have come down significantly as well, which is great. Key to any sort of successful system is a sort of a centralized data management function. You need good data. If you haven't got good data, the numbers are meaningless. And where you've got sort of, different accounts, different custody accounts and things like that, you need a mechanism of getting the data into the performance and risk system so the numbers are actually good. You find operational data issues only become visible in the performance function. So If the performance number is wrong, your clients will tell you, which is not ideal. You prefer to catch that sort of earlier on in the process. And we do find that there is a risk that for many performance and risk functions, a significant amount of time is spent on data management, and whereas the focus should be more on the value-adding activities. So even in an advisory firm where you're sort of devoting a lot of your time on client engagement and regulatory issues and sort of, meeting those requirements and sort of talking to your clients, you don't want sort of your back office team spending too much time on data management. You want to make sure that's right. And the operations tend to be fairly inefficient. So there's a lot of manual processes and bespoke tools. I call them user-defined applications, but they're also known as spreadsheets, or people use access databases and things like that. It has been seen that the cost of specialist tools is a barrier, but those costs are coming down. There's a lot of complexity about risk reporting. I think as an industry, we need sort of more education on risk reporting, and unfortunately, I haven't got enough time today to talk about it. It's an entire session in itself, but risk reporting is a fascinating topic, and I think there needs to be a lot more sort of education around that. And also client needs are often not met. So we're finding that I'm hearing that sort of the investors and clients are becoming more sophisticated and wanting to be more involved in what's going on within their portfolios and within their investments. They want to know sort of the stories and what's going on. So there needs to be the tools and sort of processes developed to engage with that.
Thanks, Chris. And David, I guess from your experience and of what Chris was discussing about how, there needs to be some kind of like control in place to ensure there's integrity of data. Within, I guess, your experience, what are the tools that you see people adopt in general?
Sure. So if we could just jump to the next slide, and I'll sort of try and illustrate it. So Chris is absolutely right. The IT and systems to support portfolio analytics have moved on at a pace. There are a number out there. I'll use one of them, which is SS&C Sylvan product, just to sort of illustrate it a bit. But really what that does is it gathers all of the information that's needed. To be perfectly honest, the starting point for performance is pretty simple. You need values and you need cash flows, and that's it. Then you can apply lots of layers of granularity over the top of that, but that's your starting point. And typically these systems now are helping acquire that data, and secondly, starting to really move the focus of firms who are calculating it away from the process. So, when you're running spreadsheets, as Chris talked about, and when you've got teams of people looking at performance, historically it's been around generating the performance numbers. The more contemporary systems out there allow those people with those skills to move the generation of those numbers across to the system, and they then spend a small amount of time monitoring to make sure the system's doing what it's expected and the results are coming out within tolerance, etc. And they can then spend the rest of their time adding value and making sense of those numbers to an audience who are maybe not as au fait with what they mean, and they can start to use it to explain their investment approach and the returns of the portfolios and why it's got there, as Chris talked about at the beginning. So these systems are out there to allow these processes to become automated, but key is to start to allow their teams to add value either internally, to their fund managers or to their sort of C-suite, so they understand what's going on, but really more importantly out to the end investors, so they get a complete understanding of what's happened and how it's got there, and it gives them that ability to communicate where these metrics have come from and what behaviors have caused them, rather than just focusing on the generation of the numbers themselves. If we can just jump on, that'd be great. Chris, back over to you.
Excellent. So this is just a sort of a very high level, very basic level sort of investment performance framework. So if you're sort of running model portfolios within your organization and you want to do some analytics over it to see what's going on. So you need some internal data. So you'd need your asset allocation policy settings, your sort of your DAA tilts, and your performance returns. You would either generate them in your performance system yourself, or you'd feed them directly through. They'd come from your custody accounts or your sort of providers. You'd also need some external data, so market prices and distributions. So you feed those through. If you wanted to use your performance system to actually calculate all these numbers and things like that, you would also need to sort of feed through, as David said, your portfolio holdings and your cash flows, and sort of that'd be a key part. But that would all feed into sort of the performance and analytics attribution calculation system. And I mentioned the Brinson model. It's a very, very famous model, which is used for sort of calculating sort of contribution, attribution, and things like that over model portfolios. And then you go through to your reporting. So with your reporting, you do your formal performance reporting, which is your straight sort of high level performance number for your portfolios. You can show it on a sort of an aggregate basis. So if you've got sort of 5 different model portfolios, you could show it for each model, or you could show it as sort of on a client level basis, so for each individual accounts. You'd run your attribution, so you can show your asset class attribution, break it down by various asset classes, and you can once you've got your data within your system, you can slice and dice it anywhere you like. So I've just used the growth income split here. You can use sector splits. It goes back to the point that I was making, that once you sort of set your framework on how you want to look at, and your clients want to look at portfolio returns and risk and things like that, then you can set up the systems to shape that view. David, you got anything else you want to add? Nancy, we'll go to the next slide. Oh, David, you're on mute, mate.
David, you're on mute.
All right.
Thank you.
All good. Rookie error. All right. Yeah. So look, as Chris said, it all comes down to data, but where the tools really excel now, where the tools really enhance what we can deliver to our clients, internally or externally, and our investors, is how they can make sense of that data. So information from data. And typically what we're seeing now are the real detail level through spreadsheet-like type approaches, and being able to drill down through portfolios, or through sort of family structures, etc., and being able to show that with the raw numbers for the people who like those, but more importantly, aggregate thematic sort of graphic displays of information, which really make that data come to life. And that's really what's changed in the last few years around some of these systems which calculate performance, attribution, and risk. Is then how on earth do we deliver that in a way which is meaningful? And this is what we're at in the stage in the industry at the moment.
Move on to the next slide, please. So thank you, David and Chris. We do have a question that's just come in from the participants. So firstly, traditionally, it's been a challenge in itself to obtain performance data and analytics for SMAs and managed accounts. What's the most efficient way in obtaining this information? Or are we restricted to what is actually published by the investment managers? So I'll hand it over to Chris first, and then David after. Chris?
Yeah, that's an interesting question. And it kind of depends on sort of the setup. So the data itself is all there. And when I say that, if it's either sitting in custody accounts, so the custodians themselves can provide the data, and if you needed sort of holdings and transactions data and things like that at client level, the custodians do that. If you're relying more on what's actually published by the investment managers, they have all the data as well. But you can approach it sort of at different layers. So if you're only restricted to what's sort of published by the investment manager at fund level, you will know within your client portfolios or within your models what the weighting is to the particular funds. And then all you need there is the headline performance return. So for example, if you had 50% of your client's portfolio in an ASX 200, XYZ manager growth fund, you could set up your system so you'd show your 50% weight. You would put in a monthly performance number for XYZ growth fund, and then from that, using these sort of systems, you could actually roll that up into a total portfolio level with all the other holdings and things like that. So really, what you do first is you look at the data. Oh, my host has asked me to start my video. There we go. Firstly, you look at the data that you do have, and then you work out the way that you want to set up your performance and risk systems. But it can be done.
Can be done. Okay, thanks, Chris. Over to you, David.
Yeah, look, not much to add to that one. I mean, I think that as Chris said, the data's been there, and I think the systems have been there for some time, but they tend to have been regarded as tools for institutional sort of fund managers, etc. I think that's wrong. I think they've got absolute applicability across the advisory and wealth and managed side of it, but there hasn't been that uptake there. So the challenge, I think, has been an uptake rather than capability.
Yeah, and my personal view, and I've spent many years and working for investment managers and a variety of roles, and particularly around performance and data analytics and things like that. Every single manager these days has the technology to provide either a CSV file or a text file showing what their holdings are, within a day or two of month end. And it's a bit disingenuous if they come back and say they can't provide that. And I know there are some managers that are particularly sort of concerned about their IP, and they say it's delayed and XYZ. But I think as clients and yourselves are clients of either fund managers or platforms or things like that, it's within your rights to be asking them for these data feeds.
Thank you, Chris. So the next question that I have is for David. Are you seeing any trends around performance measurement in the wealth segment?
Oh, look, I think we've sort of covered this earlier. I think that the trends have been around more sophisticated need data and information needs. So more granular, more frequent, different types of metrics rather than just portfolio headline numbers. And that's certainly been the trend that we've seen, and a move to sort of get rid of these sort of operational risk areas of spreadsheet-based performance. Those are the main sides of it for me.
Thanks, David. And another question from the participants. We'll start with Chris. Are there anyone using this type of analyst for platform source data / portfolios?
Sorry, you meaning, so just to clarify, anyone using the tools or
the type of analysis for platform source data? So it would be the data itself.
That I wouldn't know, to be honest. I haven't worked with anyone that is using platform sourced data, but that's not to say they're not. It's just that's sort of an area. I'm currently doing more work in the superannuation space with some of the big industry funds around the systems that are being used, as well as a couple of the IMA, or one of the IMA platform providers as well. On performance and analytics, and they're definitely using these tools and systems and processes and things like that to generate their performance and return numbers. But they tend to take straight feeds from their custody systems into the performance systems.
Right. David, did you have anything else to add?
No, I'm not aware of that. And I think, to be perfectly honest, all of the systems which are out there at the moment are capable of doing everything we've talked about here. The issue is, I think, as software vendors, it's about getting the message out there that this isn't just the area for very sophisticated investment managers to do. You can get these things up and running to do simple calculations, but way more than you can do with spreadsheets without a massive overhead, and it just frees up people and time to do value adds around the numbers. So I think there hasn't been an issue of capability. The issue is knowledge transfer and letting people know that these can be done pretty simply, and that's maybe why we're not seeing it coming out of the platform space, because of just not promoting it well enough, I think.
Yeah, and I think the way to think about it is if you're providing to your clients as part of the client reporting their holdings in your client reports and also their transactions, then you're receiving the data just in a different format. So, the data's there. It's just a matter of getting it into a format that you can feed into these systems.
Yeah. That's true. Fair enough. And for both, we'll start with David. Are the technology vendors there yet, or do they have some work to do?
No, I think I sort of picked up a bit of this before. I think they're there yet. The work is in getting it out there that actually these things are not really complicated beasts. They actually are pretty simple systems to get up and running. But I think people have been frightened off in the past, and we haven't done a good enough job of actually saying, you know what, this stuff works. It's pretty simple, and it will free up your people's time to add some value.
Okay, thank you, David. Chris, any other comments?
Yeah, I'm just sort of echo what David said. The systems are there; they're not overly complex. You're looking across the industry today. We're all very tech savvy. If you can use Excel or PowerPoint or any of those systems, it's a very sort of small step to sort of uplift the tech skills within your organisations or within your teams for some people to be able to get these performance and risk systems up and running. It's all about just shaping the data as it comes through and getting the data in the correct format.
Okay, thanks, Chris. Thanks both for your insight into performance and risk measurements. We're just going to move on to our second component for today's webinar, which is client reporting. So I'll just hand it over to David.
Sure. So thanks, Nancy. So I think this slide is just a bit of a segue in here, but in the same way that we talked about what are the options for performance calculations, for example, with different methodologies, it comes down to what you want to communicate. And so that leads into the communications piece. So if we just jump forward, please, Toby, that would be great. So we've been working with the industry for many years with client reporting, and typically these are the sort of key needs that we see coming from our clients and the market generally. And certainly these resonate, or these are really coming through from our wealth clients, and it's around how do we give a tailored, personalized experience to our investors without a associated rise in effort and resourcing from the client side. So mass customization, the ability to be nimble and have once-off requests. Investors are far more digital savvy and expecting everything to be digital. So how do we get a single solution which covers traditional reporting, which is still needed in terms of PDFs and etc., with that digital channel as well? And how do we make that efficient and consistent across both of them so we don't get differences in between them? And how do we get cohesive branding across everything? And then lastly really is how do we then understand which of those reports, which of those digital dynamic screens of information are being used and adding value so that we can really start to hone the experience of the investor. And this is sort of stuff that we see time and time again coming through from our clients and our prospective clients around this would make a difference to us. If we can do this, this is what's going to make a difference to us and to our investors. If we just jump on. So typically there are lots of enterprise grade reporting tools out there which do that, and they give you the capability to really transform what your investors are getting from you, whether that's sort of market-facing sales enablement type product-related fact sheets and newsletters through to the periodic reporting which you are either contractually obliged to do or want to do in terms of explaining how things have moved over the period, through to operational and regulatory reporting, and then that whole digital experience of bringing that information to life in a dynamic way through online portals, and then gazing back at the process through MIS dashboards. And there are a whole range of tools available in the market which do all of this sort of stuff. And typically they're going to do it based off the same sorts of data sets which you're using to power performance and attribution. So it's not around, as Chris said, get a decent data capability at the beginning, and then you can power all sorts of value adding and enhanced services off the back of it. Next one, please. And so from an SS&C perspective, we provide one of these tools. Ours is called Vision FI. It does a whole heap of things from producing PDFs automatically through to having dynamic portals with drill through, etc. Highly automated. In the same way we talked about performance and attribution, it moves people away from creating the output and the content to managing the process, to monitoring it, and then adding value around that output which is going there. So it takes what is typically a really laborious automated process, which has typically long lead times after period end, and can shorten that dramatically and also reduce the operational risk around that one. So you can concentrate on what you want to report rather than how you have to report it. Chris, have you got anything to add to that?
No, you covered it well. But it does, it also goes back to sort of the way your clients are starting to want to see things as well, and how the client sort of sophistication is evolving. So it's about to provide the flexibility, using these tools to have the flexibility to sort of shape how things are reported and how things are structured and delivered is great. Nancy.
Thanks, Chris, and thanks, David, for your insight. I do encourage participants to ask any questions that you have. Feel free to click on the Q&A button and just ask away, and I will field out those questions to David or Chris. So there is one question that's come in for David. On your experience of client reporting projects, what advice would you give firms looking to improve their reporting capabilities?
Oh, okay. So I think, look, typically it's around you've got to continue to produce your traditional reporting. So your scheduled, your static, your contractual reporting, and that's fine. You can improve that in terms of look and feel. So just visuals, that's key. But I think the real game changer is utilizing all of that to then have enhanced reporting. So typically, digital channels, anywhere, anytime, on the fly type of reporting is where the industry has moved to in some cases, and certainly needs to move to in other areas. So you've got very tech savvy investors who want, where is my portfolio last night? What were the transactions, rather than sort of month end? The two of them absolutely live hand in hand together. It comes back to this sort of consistent data across all of the reporting channels, and that's not done by manually making sure people cut and paste and reconcile on another tab in your spreadsheet. That needs to come from your core reporting system, which will grab its data from your underlying system, so it's not reinventing the wheel anywhere. I think the mass customization piece is absolutely critical. Gone are the days where you can produce a single fact sheet, and all investors receive the same thing. There's got to be mass customization in there. And from a personal, practical experience, the one piece of advice I would ask everybody to think about is, when you're looking at your reporting and what you want to put out there, don't design your reports by committee. If you're thinking about doing a reporting project and you think it's going to take you 3 months to get your first new style, wonderful reports out there, that's great. That will take 6 months or 9 months if you're doing your design by committee. So really be sharp on it, and you'll reduce your time to market dramatically.
Thanks, David. So I guess, what about clients who, yes, they do receive client reports and statements, whatnot, but what about the role of mobile reporting?
Well, that's do you want to jump in there?
Go, Chris.
Digitalization. So what we're seeing, and no doubt what you're seeing, is there's a generational shift of wealth to a cohort of investors now that are very tech savvy, and everything is done these days on the mobile, whether it's sort of laptops, phones, iPads, things like that. And I'm very much in that cohort where I want everything I'm looking at to be on the mobile. I want to be able to access, my broking accounts, my SMA, MDA performance, everything like that on the mobile. And so I think the tools there are being developed, and the mobile tools are being developed. But I think, what the industry can do is sort of look at more uptake and delivering information digitally via mobile, rather than sort of traditionally sort of via emails and portals and things like that.
Yeah, absolutely. But it's got to be consistent, and we see people trying and not quite getting there. You go mobile, then you go back to your laptop, and what you're getting isn't always in tune. That's a real killer. So you've got to be consistent, but it's got to be mobile, and I think mobile led nowadays.
Yeah, but there is a bit of a trade-off, because you don't want investors, checking their SMA, MDAs constantly and then making decisions based off market volatility and noise and what they're reading on social media and things like that. So while delivering mobile is good, sort of controlling what is delivered and helping shape the sort of narrative and assisting people not to make very sort of, ad hoc knee-jerk decisions is important as well. And that's sort of the role of the advisor and the growing importance, or even more importance, of the role of the advisor.
Thanks, Chris. I couldn't agree more. So we do have a few more questions coming in from the participants. For a mum and dad client, what do you see are the most important reports other than what an SMA MBA is required to provide? So David, I'll pass it on to you first.
Oh, interesting. I'm not an expert on the SMA MBA side, but I'll do it from a mum and dad investor perspective because I'm one of those. So certainly, and this is not just me. I mean, I hear this in other people that we're dealing, but cohort and peer analysis, I think, is something which people look for. To understand relative to markets is great. Relative to peer groups, I think, is really interesting, and I think you can do that in a way which adds value without without exposing anything that you shouldn't do. So that's certainly an area which we're seeing coming through is cohort relative reporting.
I think the other one, from my perspective, and I'm a mum and dad client as well, is there's an increased view around values-based investing. So when we say values-based, things like climate change, armaments, sort of the typical ESG type investing, people want to know what's going on in the portfolios and having an understanding on how their investments are having an impact on the world, and sort of having, and at the same time, they want to know sort of whether, taking a view on a particular value is sort of having a positive or negative impact on their portfolio. So, I kind of see a growth in that type of reporting as well, where people are saying, what am I holding? What's my exposure to climate change, and how is that performance and risk sort of impacting my portfolio? And that's growing quickly.
Okay, thanks, Chris. So the next question that I have is for Chris. How do you get performance and risk information to your end audience when they want it, how they want it?
Wow, yeah, that's always a difficult one. And it's also, the other thing to put there is in the shape that they want it as well. So gone are the days of sort of hard copy reports that get sort of posted out, 10 days after month end or quarter end or 6 monthly. They want it digital. So it's either via web portals, email, so sending it through via email, and then digitally as well via mobile platforms. And so, when I'm doing work in the performance analytics space and looking at systems and processes, one of the sort of the key things that I look at on behalf of my clients is the digital delivery of reporting.
Yeah, look, I think, and I absolutely endorse what Chris says there about the digital side of it. What we're seeing across our clients dramatically shifting in the last couple of years is a very quick move away from delivering anything over email because of security concerns. So now it's shifting to delivering emails with sort of deep URLs to a report going through a portal to be authenticated, etc. So absolutely, it's digital, but moving away from email-based stuff already.
Thanks, David. Another question that's come in from the participant, I guess for both David and Chris, what is the price range of the performance and attribution system? So I'll start with Chris.
Well, that's a hard one. It depends on the sort of the size of the organization and things like that. A lot of the system selection I've been doing is sort of for the big super funds. You're talking sort of $30 or $40 billion under management. So you're talking sort of highly complex and expensive. But then on the other end of the range, I run a family portfolio and I would report on performance analytics for that. So I sort of subscribe to a software service and pay $1,000 a year. So. But it's very, very basic and wouldn't be suitable for advisory firms or anything like that. So it's kind of a wide range. So I'm going to flip that one to David. Put him into the hot seat.
Thank you very much. Well, I'm going to go. I work for a software vendor who sells these things, but I'm on the product side. So if I talk about price, my MD kicks me under the table. But yeah, Chris is absolutely right. There's a range, and it's typically driven by what's the value that it can deliver to your organization. And so there's a whole range of pricing models around these used by different vendors, etc. Some of it's AUM based, some of it's portfolio based, some of it's how deep you go. So there's unfortunately no easy answer to that one, and a very broad range of prices.
Yep. Yeah, I agree. Okay, so I'm just going to move on to our last question. Why do firms look for client reporting systems typically? So David, do you want to answer that one?
Okay, well, normally from my experience, it's driven really by two areas. One is differentiation, either to retain clients or attract new clients, and secondly is about scale. They may well be managing their current reporting. Typically, they're managing sort of manually or semi-manually, and they just cannot scale up either to the new demands of their existing clients or to be able to attract new ones. And they need to be able to leapfrog their competition, both in terms of content and design capabilities of the reports, but more importantly, this mass customization. That's the thing which we see is really driving it, and that's both a scale and a differentiation response to what they're seeing in the market.
Chris, is there anything you'd like to add?
Yeah, so from my perspective, what I'm finding is that the demands, the information demands are going up in terms of what people are wanting to see and sophistication, but the systems and processes that are being run just aren't suitable to meet those demands. There's also a lot of data management technology as well coming down the pipe, and people are wanting to plug that into their performance analytics systems as well. So typically the firms are running selection processes to identify their requirements and feature requirements, and then finding a system that's the best fit for them.
Thank you, David and Chris, for your time and knowledge today. I'll just hand it back to Toby.
Nancy, thank you very much for your time today and over this week in hosting all three of these webinars. It's been really interesting to me to listen to David and Chris talking about what could be quite dry topics, but the key thing for me is that performance measurement, risk measurement shows an organization which understands the drivers of the advice that it's providing. And in IMAP, we think first and foremost about advice firms and the service they offer. And I integrated performance and risk with client reporting because in many ways, client reporting is the one way, apart from person-to-person interaction, the one way in which an advice firm, an advice organization, can make its intangible service of wealth management, portfolio management, tangible to clients. Listening to Chris and David today, I was reminded that one of the platforms mentioned that when they moved their reporting to mobile, the number of times in which clients actually interacted with their personal portfolios went up by an order of magnitude. So it seems to me that for a wealth management firm who want to create an organizational relationship with clients, a relationship which transcends the simple single person advice relationship, then reporting, and in particular mobile and report generation relationships will become absolutely central to positioning themselves as an organization with unique capability that the client understands and values. Thinking about the IMAP Awards, I'm reminded that the year before last, the winner of our Innovation Awards was Elston, and the key innovation which the judges for the awards thought was worthy of note was their capacity to demonstrate to clients through mobile the reasons why they had made particular decisions about portfolio changes. So each client, when there was a change to the portfolio, each client received a rationale for that in a mobile form. And Elston felt that that was particularly appropriate for their way of demonstrating the value they were adding. In our licensee awards each year, we ask licensees to demonstrate the way in which they add value and use reporting as part of their service offer. So thank you very much for joining us today. It's been a pleasure for us to host this series this week. We look forward to you joining us next month when, as I said, we talk about building a client base of wholesale, not-for-profit clients, almost completely with practitioners discussing what that means for them. Then join us live in Brisbane, Sydney and Melbourne for the Advisor Roadshow in May. To the questioner from Adelaide, no, unfortunately, we're not going to Adelaide this year, but next year perhaps. We will, however, be in Perth on the 1st of June for a delayed, thanks to COVID, portfolio management conference. And so for those of you who are in Perth, I look forward to seeing you in person. I'd encourage you to enter the IMAP Managed Account Awards. These are designed to showcase best practice, and it's an opportunity for you to demonstrate to your peers and to the world at large what you do, why you do it, and the value that you add. We have a really experienced judging panel made up of leading independent consultants, and I can tell you that the consideration which each entry gets really is significant and deep. So thanks for joining us today, and we'll look forward to engaging with you again. Thanks, Nancy. Thanks, Chris. Thanks, David.